please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
It is very rare that the same person has commercial banking experience, central banking experience, and experience in global financial institutions. But today, my guest indeed is an all-rounder who has seen the world of finance from all these quarters. My guest is Mr. José Vinals, Chairman, Standard Chartered Bank PLC. Thank you very much, Mr. Vinals, for joining us. We are hoping to learn from your experience in the Central Bank of Spain and your experience in the International Monetary Fund, where you spent some difficult years, 2009 to 2016.
Thank you very much.
All right, so actually I'm starting from there. How would you look at the global problem today? We appear to have an issue with global trade. Do you think this protectionism is something that will pass and nations will understand the importance of bilateralism and global trade? Or do you think this is going to escalate?
Well, we are seeing something different in the last year and a half as a result of some of the political changes that have taken place in particularly after the elections in the United States, but also in other places. And I think we have gone from what I would say an environment of open globalization to an environment of sort of managed globalization, where you let some parts of globalization flow freely, but whenever there are parts of globalization which you think are adverse to you, you try to manage them. And that's what we're seeing now in the United States, where there is a surge in protectionist talk. Certainly that's the case. And also some recent action in terms of imposing tariffs. Now, I think it's very important not to confuse this with a trade war. I think what we are seeing now are trade frictions, but we are very far, fortunately, from a trade war. These trade frictions may be part of a process of a long-term process of negotiation, where the United States and China sort of realign their trade to make it more even. But I think that some of the things we are seeing are going to be with us for some time. It's not what I think is the best for the world, because I think that either trade frictions or trade wars ultimately, which I don't foresee, lead to no winners and to all losers.
Absolutely. No, I take your point that we are nowhere near a war, and even the events of the last few days indicate that both China and the United States are willing to sit down and talk. The United States tariffs are riddled with exceptions, so they're not applying to many countries. That's true. But there is an underlying trend. I mean, what was Brexit, if not, a bit of a resistance to globalization as well? Even when the United States is talking peace with China, probably that government is refusing to okay judges to the WTO. So do you think the thaw of the last few weeks or last few days will not last, and we may see a resurgence in some form?
Well, I do hope. Let me tell you what is my hope and what might be my expectation. My hope is that these things abate, and that we will continue to support multilateralism as far as international trade is concerned. I think that the world has benefited tremendously, not only from having a multilateral trade environment, but also from having multilateral institutions. And this is, I think, a global public good that we need to preserve going forward. In the case of the United States and China, which is the main one, if you look at the impact of the tariffs that the United States has imposed, the initial tariffs on steel and aluminum, we, Standard Chartered, have looked at these things, and what we have concluded is that this is something that will have an impact on China, which is about 0.2% of Chinese GDP. But with the equivalent retaliation from China, this is something that will have an impact on the United States, slightly smaller, on GDP of 0.15% of GDP. So those are very small numbers. They're very small numbers. But if we were to go to the 60 billion tariff that the United States has been talking about, this is something which, depending on whether this is just tariffs or goes beyond, this is something that would have a more meaningful impact on China, which could exceed 1% of GDP. But indirectly, this is something, all of these tariffs end up hurting the United States because many of the industries in the United States which use Chinese products as inputs for their production will be hurt. Simple example is, the beer manufacturing sector. You impose a tariff on aluminum, and then the beer cans are more expensive to manufacture in the United States, so you have to increase the price for consumers, so American consumers get hurt, and the U.S. manufacturers are hurt. Another thing which is very important is that the United States exports goods to China, and when China exports other goods to the United States, many times they have a U.S. component, and in fact, the United States is the #2 country in terms of importance in the content of Chinese exports to the United States. So again, you end up being hurt.
All right. So hopefully, therefore, it won't get too bad. Okay, let's discuss the global economy itself. You've long watched it as an economist. Do you think that finally we are hitting synchronized global growth? And this might be perhaps 2018 might be the best year of growth in probably the last 10 years?
I think so. I think this is 2017 already was the best. 2018 is expected to be, and so far it is, slightly better than 2017. And the global economic recovery is stronger. It is certainly broader, reaching out most countries in the world. And it's also healthier because it's underpinned by higher trade and investment than in the past. And this is very important for the health of the recovery. Now, what is critical is that now that global trade is growing faster than global GDP, that we do not do things which undermine trade. Because if we undermine trade, we are also going to undermine one of the pillars of the economic recovery, and we could break the back of this recovery that we have now, and which is so important that we maintain it, sustain it, and strengthen it going forward.
I want to take that word you said, healthier global economy. Is it healthier? I mean, in the sense, we could see 3 more rate hikes from Fed. It's quite possible, or at least 2 more. We could see, of course, according to their own chart, 3 more next year. Do you think at some point, in some place, in some asset class, there could be bubbles that will destabilize? After all, credit has been cheap for so long. Do you sense trouble when the Fed goes down that path?
Well, I think that the fact that the Federal Reserve Board, and also going forward, maybe the European Central Bank and so on, are contemplating or are actually acting to normalize monetary policies, I think that this is a sign that the economy is now in a much better position and therefore doesn't need the degree of monetary accommodation which was necessary until now. So I think that this is a healthy symptom. It would be very bad news if we were to remain with low or zero interest rates in advanced economies for many more years. That, I think, would be not certainly good news.
Yeah, but what about the pockets that have gotten used to cheap?
Okay. The good news is that this normalization is happening. And the normalization signaling a recovering U.S. economy, that means that the United States now can play a stronger role in leading global growth, which I think is something which was lacking a few years ago. So I think that this is good news. Now, I think the important question is whether the pace of increase in interest rates in the United States is going to be gradual, and markets are expecting, a number of hikes, between 3 and 5 hikes, let's say, between this year and next year, 5 to 6 hikes. And if this is something which proceeds are expected, I think that this should not lead to any big convulsions. Certainly, it is the case that long-term interest rates are going to increase and that assets would be repriced. But as long as this happens on top of strong economic fundamentals, I think that this overall is going in the right direction and we shouldn't worry too much. However, I think it's also the case that if interest rates in the United States were to end up rising more rapidly significantly more rapidly than what is built now in market expectations, that this is something which could cause some trouble. And I think that this trouble could be in those asset categories, as you were alluding before, which may be slightly overvalued, like some equity markets. But also, in terms, this could have implications for capital flows to emerging markets. And emerging markets which have weaker fundamentals could suffer. So this is why it's very important that every policymaker in emerging markets, they look at their fundamentals and they ask a question, if these what-if scenarios were to happen, are we prepared? And if not, because there is still time, what else do we need to do in order to strengthen our capacity to resist the winds of capital outflows, and how to best protect our economies from those potential risks?
We need to take a break, Jose, but we are coming back in a jiffy, and this time questions about India and the Indian banking system. We are back in a minute. Back to this special conversation with José Vinals. He is the chairman of Standard Chartered Bank PLC, but more importantly has been a central banker and has been an economist with the International Monetary Fund. Okay, Mr. Vinals, banking. Indian banking is in a very interesting situation. There are some problems with a lot of corporate lenders, largely public sector banks, which have a lot of bad assets. And then recently there was also a fraud in one of the banks. Not very big compared to the size of Indian banking, but still, this is raising questions as to whether public sector or running banks in the public sector is a good idea. What are your thoughts?
Well, I think that there is no one-size-fits-all. And I think that the international experience shows that public sector banks can function well. But for that to happen, you need to have, in all cases, proper corporate governance, and that decisions are made in a way that are prudent and that achieve the sort of goals of these public banks, but also ensure the return of the loans in order not to have non-performing assets down the road. So I think that the criteria of prudent banking applies to either private banks or to public banks.
The fear is that there could be more political interference in public sector banks. Or even if there is no political interference, can you run modern banking as a government department? It's an efficiency question I'm asking you. There is the other side, which believes that private sector banks have not covered themselves with glory all the time. But, I mean, as a person who has seen banks in many countries, what would your...
Well, I think that the international trend is for a larger scope for private banks and a narrower scope for public banks. But that doesn't mean that public banks cannot and should not play a role. Even if you look at advanced economies, you have public banks playing a role. Public development banks, you have them in Germany, you have them in Spain, you have in other countries. If you look at the United States, which is the paradigm of the most sophisticated financial market in the world, what you can see is that two government-sponsored enterprises, Fannie Mae and Freddie Mac, those played a very important role in the mortgage sector, and in mortgage financing. So you always have, or you also have these public banks there. The important thing is that these banks are run properly and that they do not take risks which may compromise their future. That's a critical thing. So that's why I emphasize the issue of corporate governance and having a prudent risk management framework being adopted so that the decisions do not ultimately undermine the stability of these institutions, because that is negative. So again, there are good and bad examples. And I think that compared to 50 years ago, the role of public banks is now much narrower. But even with this narrow role, if they are well run, they have a role to play. And also, it doesn't mean that if you're a private bank, you're going to do a good job, because the global financial crisis showed that private banks, or commercial banks, when they are run, or investment banks, when they're run in a way which is not prudent, they can get themselves and their countries and the world in a lot of trouble.
We were, of course, hoping in India that as we have more digital payments, we could data mine and give more loans to unbanked segments. India has only recently extended banking services to practically the entire population. So we are very hopeful of digitization. But do you think before we get there, the world may actually get some aversion to digitization? The way in which we've had these Facebook and FANG stocks perform because of the problems. Do you think we are already, troughing out?
I think there are two things. One, and if you think of India in particular, this is a country with an extraordinarily dynamic demography. So young people are more and more important. And that happens also in many other parts of the world. And young people, the millennials and so on, they relate to the world by the use of technology. And for them, digital technologies is key. So we really need to make sure that we use digital as a way of banking the new generations. Now, I think that the fact that you have had problems with Facebook may tell you something. It's not saying that digitization is bad or that technology is bad. What it's telling you is that when you have big companies which have access to data, this data needs to be better protected or regulated. We as banks, we get a lot of data from our customers, but we protect that data. We do protect that data. If you come and you want a loan from us, and we know a lot of things about you, we are not going to let this data go into the public domain. This is absolutely confidential information. And that hasn't happened in the case of Facebook. What you have now is that these big companies, they're global companies, they're companies which are not subject. They're doing a lot of quasi-banking services. They are not subject to appropriate regulation, unlike banks. They are not subject to appropriate competition regulation, unlike any other company. And even in terms of taxation, it is unclear when they pay taxes or not. And then there is data protection issues. So what this is telling you that technology, digitization is critical, but we need to review some of the aspects of digitization to make sure that they do not compromise consumer protection or the safety and soundness of the financial system. For instance, some of these big companies or the cloud are providing services to a number of financial institutions simultaneously. So they become a kind of new sort of too big to fail institutions.
Oh, yes.
And therefore, they have attracted the attention of regulators lately. So digitization, yes, but with some safety standards that I'm sure will be forthcoming.
Oh, yes, you've pointed out to a lot of regulations that should come in. I'm more worried that privacy laws should come in, at least in our country. A final question to you, and I thought I would spend more time in that, but we're out of time. What do you see as Standard Chartered's role in India?
Well, we are in Mumbai, and I love this monument gateway of India. And I think that Standard Chartered we want to be a gateway of India into the world and a gateway of the world into India because of the special role that we play in financing trade and investment cross borders. For us, India is a very, very important market. We've been here for 160 years. In fact, Standard Chartered was a merger of two banks, one of which was a charter bank of India, Australia, and China. So we were born here. Half of the bank was born here. And this being an economy with such an outstanding growth performance, which I hope will be enhanced in the future through the appropriate policies being pursued by the government. A country which is now, in terms of purchasing power parity, the 4th largest economy in the world, and in terms of market exchange rates, the 7th economy in the world. We think that, and with this tremendous demographic dividend, which, if the young people are properly educated, would be a tremendous source of strength for the Indian economy, this is a market where we are very committed, and we are investing and developing new things all the time so that we can help India continue to develop, take their true place in the world, and India's success is our success.
Thank you very much, Mr. Vinals, for making us feel that, well, we are about to take leadership of the world.
Okay.
Thank you so much.
Thanks very much indeed. Take care. Thank you.